CommitToWealth.com, creating a legacy by committing to real estate wealth.
Welcome back, everybody, to another episode of the Commit to Wealth podcast. I'm your host, Juan Vargas. With us today, we have two people that are very exciting. They have a ton of experience. I'm going to go ahead and introduce them as Janie Grenier and Kyle Duelund. So Janie and Kyle are co-founders of Wemindji Properties, S.T.R Properties, and J.K.'s Real Estate Partners. Their focus is on affordable residential housing, specifically manufactured home communities, multifamily properties, as well as short-term rentals. So Kyle and Janie, welcome to the show.
Thank you so much. It's a pleasure being here. We look forward to giving you and your audience everything we got.
Awesome. Everything you got? Okay, well then we're gonna be in for a treat here. Okay, so for those of you guys listening, Janie and Kyle are business partners, but not only are they business partners, they're also husband and wife. And you know, and just so happens that they just recently got married, right, a couple of weeks ago. So congratulations.
It's true. It's not the middle finger. It's there it is.
It's the ring finger. Yeah, that's what it was the ring finger. So just to clarify that. So hey, once again, congratulations. And before we got on the show, before we started to record, you guys were saying that you guys are going to be gone for a couple months. So tell us a little bit about that before we get into your background. I just want to, because I thought it was pretty cool that you guys are going to be going for 2 months. You know, so that's pretty amazing.
Yeah, tell us about where we're going.
Sure, thank you. We're heading out to Southeast Asia for 2 to 3 months, from January to March. And basically, that was one of our whys when we first started in real estate was, why do we want to do what we do? Is because we wanted to travel the world. And so everything that we've done to this point, everything was always with the idea that we are going to generate basically our businesses from our phone and do it and be able to do it from afar. So that's how we're able to travel the world. And with all the systems that we've built throughout the years, got us to this point today.
That's amazing. And really, you know, everybody, well, I wouldn't say everybody, but most people out there, right? They strive to be able to get to a point like that you are at right now today, these days, right? And so, you know, but as we said, you know, if it were easy, everybody would be doing it, right? But it just goes to show you that it's not easy. It's not easy to get to the point to where you can take 2-3 months off out of a year and just go have fun and relax and really enjoy your life, right? The life that you have been able to build. So, you know, I kind of want to talk about your mindset, right? But before we go there, I want to talk about your background, right? Who is Janie? Who is Kyle? Tell us a little bit about your backgrounds. You know, how you guys maybe met, how everything kind of started, and then we'll also kind of get into the mindset. You know, and we'll take it from there.
Perfect. Well, professionally, I'm a registered nurse, and I have a specialization in Northern Canada nursing. So it's remote nursing with the Aboriginal people of Canada. I've been a nurse for over 13 years now. And this lovely young man,
thank you.
He was a former math professor teaching at Concordia University. And we met in Wemindji. So the name of our company, it's a small Cree community in Northern Quebec. And that's where we met. So I was nursing and he was doing his last stage. Basically, he was working in Wemindji with some Cree people. So it was really fun. We met up there through our former life. And then since then, well, we started our companies afterwards.
So when was this that you met exactly? Like what year was this?
6 or 7 years ago.
6 or 7 years ago. So you guys met, locked eyes on one another, and then you guys knew right then and there that it was going to be a great, fun ride from there, huh?
I certainly knew that was the case. The funny story, and I won't spend too much time on it, but basically, I'm math. I did my studies in teaching mathematics. So, and I taught Concordia. I taught from actually elementary school all the way up to university. So I've taught everything in between. And but when I met Janie, I was very much the in the box type of guy, you know, valedictorian. You know, I give me the rules and I'll be the best at following them, which is not the business owner or the entrepreneur's mindset, right? It's a very good COO, but not a very good CEO typically. But anyway, so when I met Janie, it was the first time that I was really outside the box, and I met this woman, so young and yet so driven with so much ambitions. I just couldn't believe what I was seeing and what I was hearing. And I knew that I had the skills and I could help get her to where she was, get it out of a dream and into a goal. And on top of that, like, you don't know Janie, but she is one of the most amazing, and I'm thinking about my vows again, but I mean, the most pure, the most genuine, and just the best person I know. So that's why I married her. So I just wanted to devote my life to help her achieve her goals. And so we've been on that ride ever since.
Awesome. So yeah, you're right. We don't know Janie, but we're going to get to know her a little bit more here within the next 30 to 45 minutes or so. So awesome. Well, congratulations once again. So
thank you.
You know, that's how you guys met. So tell us how business kind of came together, real estate kind of came together, what year was that, and what sparked that idea that saying, hey, we can actually do something here.
So I come from a middle-class family. We don't own real estate. We don't necessarily own businesses, but I knew from a young age that real estate was something I wanted to do. I remember being like 7 or 8 years old, dreaming that I was owning the island of Montreal. And Montreal does have a population of about, I think, 3 million people. So there's a fair share of real estate on the island. And I dreamt that real estate was going to be my go-to to wealth. So at the age of 19, I actually bought my first property by myself with a commitment from a hospital saying that I was going to work full time. So that's how I bought my first property. Bought my second, I was 24, 27, the third one. And then, well, now we own over 120 units in a very short amount of time. Basically, so real estate was something that I've always wanted to do, but everybody around me was telling me that I was crazy, that I couldn't do it, that we didn't come from a family of means, that it was just not in the cards for me. And I should stick to the box and be very good at being a registered nurse. And so that depressed me quite a bit to a point where, there was a point in my life where it was quite dark. I didn't know how to move forward because I have all these big dreams and aspirations, and I didn't feel like I belonged anywhere until I met Kyle. And Kyle was the first person to actually tell me, okay, Janie, tell me what your dreams are. Let's write them down and let's see what we can do about it. Obviously, my list of dreams, is pretty long. I want to help a lot of people in the process as well. So it wasn't by being a nurse that I was going to achieve that. So he was the first one to say, perfect, your list is long. So your goals are going to have to be, you're going to have to do something big about it. And so that's how we started real estate. Was I had this passion for real estate. I signed us up for a mentorship coaching session. And from there we started.
Okay, so what kind of mentorship coaching session was this exactly? Was this more like residential? What was, kind of tell us about that, but also tell us about like your first, property, maybe your first couple of properties, what exactly those properties were, and where exactly did you buy those?
Perfect.
Sure thing. Yeah. So it starts like most starts, I guess, with a guru. So you get invited to a free preview event. You go to that, you get excited, then you sign up for the weekend event. A couple $1,000s on the line. You learn a lot of information, and then they sell you on the package, right? And so we paid for the big package right out the gate. We were green, but we were hungry and we were driven, and that's still to this day the main criteria of success, in my opinion. So anyway, so we paid the big amount, and then we just went and hit the road. Made calls. We made it our full-time ambitions to make this work. So for the next 9 months, we would be studying, attending more seminars, reading, bigger pockets and blogs and everything we could. We'd just take it all in. And we decided to start in Florida and Ohio. We wanted to buy and hold in Ohio because the cost of entry was so low and the rate of returns for buy and holds were much higher on average. There was proximity to where we were living as well. Mm-hmm. Proximity. I mean, it was drivable. And then Ohio and Florida was going to be where we're going to do our fix and flips. However, in that 9-month process, already the Florida market was picking up fairly rapidly after the crash and got out of hand for our budget, for our initial capital. After paying so much in mentorship, we only had limited funds to actually get started. And so we decided to put Florida aside and focus on Ohio, Cleveland specifically, and that's where we got started. It took us 9 months to pull the trigger on that first property. After many visits to the market, meeting many contractors, realtors, the whole shebang, the power team, we finally pulled the trigger. It was a single-family home in a suburb of Cleveland called Euclid. We still own that property today. It's now one of our short-term rentals in Cleveland. But that first property, we paid $9,000 cash.
Wait, 9,000? So yes. What was it? Just 4 walls and I mean, what was this? 9,000. What are you getting for 9,000?
Actually, quite a beautiful home. It's 1,800 square feet, 4-bedroom house, 2-bath, and solarium. Very nice house. Obviously, it was a bank-owned property, but it was a nice house. It needed some rehab, but with $35,000 of rehab, it brought it back up. So,
and of course, the property's not worth $400,000, right? So we bought it for $9,000. There was a $5,000 wholesale in there. So just FYI, the property was actually for $4,000, and we paid a wholesale.
Oh wow!
For $9,000. But that's so. Anyways, bought it for $9,000. We put in $35,000 into it, and then we had an asset that was worth what did it appraise for? $69,000, $79,000, $79,000. It appraised for $79,000 after we were done with it. We went back to the bank. We owned it free and clear. We BRRRR'd it out. We put a mortgage on it. The bank gave us basically $40,000 back. Got all of our capital back. Put a tenant, cash flowed $300, $350 a month, and we had the capital to buy another one, and so we did.
Awesome. So, just to tell the audience, you mentioned that term BRRRR.
BRRRR.
Tell us a little bit more about that for the people that don't know exactly what that is.
Yeah, for sure. The BRRRR strategy is for people who like the cold and like us Canadians, and we just always BRRRRing it, No. Is B for buy, then you're going to rehab, the first R, and then you're going to rent, refinance, and repeat, BRRRR. So it's a strategy to recycle the same capital and continuously buy real estate with the same initial capital. And in the US, which is really nice, is when you go into these short-term fix and flip loans, you can refinance before the 12-month mark. So as soon as the rehab is completed, the value of the property, you force the value up through the rehab. Mm-hmm. And so banks deem it a qualifiable refinance asset. And so as soon as it's done, if you finish the rehab in 1 month, go back to the bank, start the rehab process, and your money could be back as soon as 2 months into your bank account. So it's a way to recycle capital fast.
Mm-hmm. Yeah, so I've seen that, and I've actually done that as well, and that's the reason why I even knew about the term. It's a great way to, like you said, recycle the capital, your capital. I mean, let's face it, a lot of us have limited funds, right? So if you have limited funds, what's the way that you can get into a bunch of different properties, within a short period of time, with the same capital, right? So you're putting this capital to work overtime, like triple overtime, and it's just you're using it in one property, refi, get the cash out. You can possibly even get some capital back, kind of like you did, and then you take it and you keep working it, and before you know it, within a matter of a couple of years, you're gonna have several cash flow producing properties, right? So it's a very good way to grow in a short period of time. The key there is to make sure that you get them for a good price, right? It has to be for the right price, because it has to be able to, you have to be able to refi your cash out, right? And if it doesn't appraise for a certain number, then it's just not going to work, and you're going to be leaving a lot of capital into the property, and that's really, it kind of it doesn't help there, because the whole point of doing the process is getting capital back, right?
Exactly. That's exactly what we teach. We wrote a little ebook. It's free online, and it's basically the concept of MAO. I don't know if you've heard that one. Your maximum offer. So that's the number that if you can buy and rehab and hit that number, your finance will cash you out entirely your initial investment. So that's the goal. You always want to. When you hit the refinance, to get all your money back. You always want to target that. Anyways, that's what we always want to do.
And
sure.
So you make your money when you buy, not when you sell. So you need to make sure that you know your exit strategy before buying. Make sure that your numbers work beforehand.
So how do you know what your exit strategy is going to be, like on a particular property, and how do you know that your plan is going to work, right? It's kind of hard to tell, really, because if your strategy is going to be a year from now, 6 months from now, 2 years from now, I mean, you can have a plan, but do you have like a plan A and then a plan B and then like a C, or do you typically just have one plan and then just go with it and then hopefully it works out at that point?
Right. So that's an excellent question. It's very, very relevant to everyone who's thinking about doing this. And it changes by market. It changes with what lenders you're using. It changes if you're dealing cash or whatnot, because you have different options in those cases. But for example, we operate heavily in the residential space in the Cleveland market. And in Ohio, in Cuyahoga County, in Cleveland, lenders tend to shy away from that county and that city for various reasons. So that makes it that if you're buying properties that are appraised after repair value under $100,000, it makes the refinance much more difficult on decent terms. And so that's why we're always aiming for properties who will appraise 110 to 175. So we're not under the 100. So the refinance is always an exit strategy, right? Even if it's a short-term refinance and we're waiting out a recession or a downturn, whatever it is, we can still do the refinance and ride the wave. So that's one. If we're looking to buy and hold, we're never going to buy an asset that we're not going to cash flow at least $200 a month. So that's right out the gate. You can figure out the number with your property manager or your realtor can give you some numbers on what market rent is in the area. You can go on certain sites like rentalmeter.com. You can get that data before actually buying the property, so you can extrapolate your exit. And when it comes to a flip, it's just a matter of what type of spread that you're comfortable with. Can you buy Rehab and then sell it for $25,000 higher, $50,000 higher, whatever your number is? Stick to your criteria. Figure out what you're comfortable with, and then don't budge, because there are deals that will meet your criteria. You just have to be patient and wise enough to find them.
And that's definitely the key, is to make sure that you are patient and, you don't try to force any numbers, because it's so easy to just kind of, move this lever, turn this knob and okay, I think it'll work now. It looks better now. I feel better about it now. But, all you're doing is making it a little bit more risky, right? So you don't want to do that, right? So you got to make sure you stick with your numbers, and if they don't work, and just move on, right? There's going to be a bunch of properties that you can go after, so don't worry about that. So, okay, so that's more on the single family side. So let's kind of shift gears a little bit, like more on the larger properties, like some of your multifamily properties, some of your manufactured home communities. What kind of got you thinking, okay, so I've done single family homes, let me switch over to something like this, like manufactured home communities, versus, hey, let me stick with single family homes and do this all the way. What was the thinking behind that? And then, kind of tell us a little bit more about your first couple of deals there on the larger side.
Sure. Well, okay. Well, how about I just preface this just to give you a little bit of perspective and context. In our first year, we set the goal that we wanted to buy 10 properties in our first year of investing. And so it started with that single family home, and we BRRRRed it to a second and a third, and then we started small triplex, and then we just kept on going. So it wasn't just single family home, mobile home park. It progression to get there, because yes, bigger assets, bigger numbers, more appealing, but also when something breaks, the numbers are bigger as well. So you better have those buffers and those cash reserves in place to not make real estate investing a stressful endeavor, right? Yeah. But you want to talk about our first mobile home park?
Sure. So the whole idea behind the mobile home park was very appealing to us. One, it's a community. So you're changing a community at the same time. In terms of due diligence and actually buying the mobile home park, it is a little bit more time intensive, but it's still just one closing, like one single family home. So when you get really good at doing due diligence for bigger assets, it's quite interesting. It's quite the breeze. And really you're working for one asset class. So that's nice. Now, the reason why we decided to do mobile home parks, well, first of all, the person who introduced that was our mentor. So we had never heard about that before, but we thought it very interesting. And the one thing that we really liked was that there's a lot less competition in the mobile home park space than there is with the apartment space. So a lot of these owners that built the mobile home parks in the 70s and 80s are now looking to retire. Most of them are baby boomers, and they're just looking to get out of the asset class. And so there's a lot of opportunity right now in that asset class, which we really like. So a lot of these owners don't know how to price their mobile home park. There's realtors that don't necessarily know how to price them as well, because it's a different monster altogether. And so there's a lot of opportunities to get in with owners without going through a realtor, and just offering what you want to offer based on a cap rate. So that was very interesting. Mm-hmm. And we really loved the idea of just uplifting communities at once. That was something that we really like. On top of that, mobile home parks or mobile home communities, basically that's affordable housing at its best. There's no other more affordable housing than mobile home parks. So lot rent, for example, in our parks, for the most part, you're looking at about $300 to $325 a month. And most of these people, most of our tenants actually own their homes, which is our business model. We want them to own homes. So we're just getting the money for the lot rents. Hence, if they own their home and they pay $325 a month, that's basically their monthly payment. There's no other apartment or, two-bedroom house that will cost you $325 a month anymore. So typically these tenants are quite stable. They attract, the low price point actually attracts people into your parks. And we just help people that are on Social Security with low income remain in their homes and offer them a nice place to stay. So those are pretty much the reasons why we decided to go into the mobile homes parks.
It makes a ton of sense, and I always kind of tell people, like, so you have like your Class A stuff, right? And if you're a Class A, then you're a renter or a tenant by choice, right? Because you can most likely go afford your own home, right? So there's the Class A stuff. There's the B, which you can kind of go either way, right? You can possibly buy your own home, or maybe you want to rent. It could be by choice, but it could also be by default, right? But by necessity, rather, right? The C's, is by necessity. It is what it is, right? And so if you can't afford maybe a $600 or $700 rent payment a month, which is the C properties or whatever, right? And I'm speaking about multifamily properties like apartments, right? Then what do you have left, right? So then it's the mobile home communities, right? The mobile home communities where it's $300 a month. And if you can't afford a $300 a month payment, then you're like in the street.
On the street,
right? And so that's why, like, whenever you talk about recessions, you talk about, market corrections, shifts, that's why mobile home parks are one of the most durable, one of the most resistant whenever it comes to that, right? Because, if you're at the bottom, then, hey, you don't want to go to the street. So, but it's also one of those where it's very cash flowing as well. It's high cash flowing type of properties. And like you have in your community, the tenants own their own homes, so you don't have to pay for the maintenance, or you're not in charge of the maintenance. You don't have to deal with those hassles. They take care of their own things, and then they have to pay for the rent and utilities and all those kind of things, right? So it's very, very neat and very, very cool how it works. Tell us about that property specifically. Where did you buy it? What was the price point? How did you get the financing? Tell us about those things. Be a little bit more specific on that.
Sure. So we put together a team of brokers that we work with. So we basically go after off-market properties, and we have a very specific follow-up system where we basically establish a relationship with the seller, and it often takes us months before we close a mobile home park. And the first one that we bought, I think, took us 10 months before we actually bought the mobile home park. There is seller financing involved, and it's in Southeast Michigan. And our first park was 29 lots. And the price point after negotiations was $160,000, I believe, right? With half of it was seller carry. And it was a 20 cap?
It was
21 cap rate.
Yeah, damn near a 20 cap.
20 cap rate.
Wow.
Is with upside.
Yeah. So you can.
How many pads was this again?
Sorry?
How many pads was it?
It was a 29 lot.
29 lot. Okay.
29. At purchase, there were 16 occupied.
So how were you able to do the financing? Like, what did that involve? And what was your leverage on that too?
So as Janie mentioned, there was a significant seller carry involved. So what's really nice about mobile home parks, it's kind of almost like an alternative asset class. What do I mean by that? It kind of falls a little bit in the trailer, fifth wheel, timeshare. It's these asset classes that have typically a bad stigma attached to it. And for that reason, creative financing is almost commonplace. Whereas if you're looking to get started in real estate and you're trying to negotiate this apartment building and you're talking to the owner, okay, well, can you carry 50% of the purchase? They're almost going to laugh at you most of the time, unless you've built some significant rapport and you really know what their pain points are and you can create a solution that directly solves their pain point. But in the mobile home park space, very, very commonplace to have creative terms. So this particular mobile home park, we were out of pocket under $20,000 to buy. So we had we have a specialty broker that will lend on anything so long as it cash flows, which is our business model. We only buy if it cash flows really well. So he was okay. And he was first lien position. His lien was 60,000. So we bought it for 160. He was 60,000. So his ratio was about 30% or so. So he's comfortable. And on top of that, it appraised for 250 because we bought it so well. So really his ratio was, he really wasn't afraid. And then the seller carried more than 50% as well. So, and then you basically negotiate your own terms. So we had, 5% over 5 years. And interest only. So you're keeping most of all that cash flow to do what you need to do in the park, like infill those vacant lots, like, catch up on the deferred maintenance. And this particular park had private utilities. So that's a new concept for most investors. Water and septic are the owner's responsibility. So, if the water lines break and you have a privately owned system, well, it's on you. The city's not going to come fix it. So there are additional considerations with mobile home parks. But nonetheless, the seller we had a first position. So we were only out 20,000. So you can see how the transition from single families and small plexes isn't that far off in terms of financials to jump into a small mobile home park, for example.
So was this something, as far as the seller carry, right? Was this something that he offered, or was it something that you guys asked for?
So I forget the specifics, but the theory around asking for carries is you don't ask. You want to, in your negotiations process, have them propose it as a solution. For example, let's say this particular owner, I think, wanted 230 at first, or like that. And I said, well, our cash offer is this. I'm sorry, 230 is not what the park's worth to us. So this is our cash offer. This is our cash offer. This is our cash offer. And months, don't forget, this was 10 months. So 10 months go by of us just, hey, did anything change? Did you, can we work this out? We really want to buy this park, but your numbers are not making sense to us. So eventually it comes out to, well, okay, 160, but under these conditions is how it's going to play. And so is 160 what you're comfortable with? And eventually, I didn't explain that right at all, but ultimately the seller has to propose it, and it has to solve a problem that they're living. They're not going to do something because it pleases you. They're going to do something because it pleases them. So how
it benefits them? Yeah. Yeah. So in this case, you're giving them 5% interest only, for 5 years, right? So, which is something that's beneficial for him because, one, you have the capital gains, right? So you can kind of, divide those a little bit, right? If they're going to be holding for a while, then you're not going to be the seller's not going to be taking that big hit, right? Initially. But the other thing is that he's still going to continue the cash flow, right? Because of the interest that you're paying him. So those are some things that maybe that was a need for him, or and for him to make the deal work, it was something that he was requiring. And it just so happens that it's also beneficial for you guys as well. So
that's right.
Where was this park at exactly? What market was this?
It's in Southeast Michigan.
Southeast Michigan. Okay, gotcha. Okay, well then that's pretty cool to know that you can be pretty creative and having the seller's portion, and just kind of put it all together to make it work. As you started off with what was it, 17 filled spots, and now you're at 29. So how were you able to advertise to get those remaining spots filled in? And what was that process like?
So we have a particular strategy that we've coined ourselves. We call it the 3-2-1 process. So 3-2-1 is a ratio that we like to follow to infill mobile home parks. So 3, you're going to buy 3 used mobile homes out of your own cash. You're going to buy them from wholesalers. You're going to buy them at a discount. In Michigan, we can typically buy a home for about $10,000. All right, you look around, that's like what a deal would look like. 3 mobile homes you're going to buy used and hook them up yourself. Then the 2 of the homes you're going to apply for the 21st Mortgage Company cash program. This is a program owned by Warren Buffett, right? 21st mortgage. And it's a trifold agreement. Okay, this might be a bit technical, but if just bear with me, because for mobile home park owners who don't know about this, you want to know about this. So it's trifold agreement. There's three parties involved: the bank, 21st mortgage, the mobile home park manufacturer like Champion Homes, and the park operator, the investor, us in this case, for example. Mm-hmm. So how it works: the bank is going to buy a brand new off the belt mobile home from the retailer. Okay, the bank is going to buy it from the retailer and basically move it to the park operator's park, right? So effectively, a brand new home finds its way to your park. There's a few involved, but negligible, and they get reimbursed, so as if nothing. Okay, so and then from that point on, it's the park operator's job to sell that home, to become the retailer, to sell it to an individual.
Okay, so tell us a little bit more about the cost that, okay, so you have this new mobile home that's on your park, right? So now it's on your property. Now your job is to turn around and sell it to somebody else that could potentially live there. So what are we talking about as far as costs, give or take?
Right. So you want to talk about this?
Well, I mean, it's quite negligible. It costs, so the trailer will be moved to your lot, and then you have to hook it up to your system. So you have to go get your permits, the city permits for water and electricity. And after that's done, so let's say it's about $2,000, $2,000 to $3,000 on average. That's what it costs you to hook everything up and make sure everything's kosher. Once that's done, you tell the Cash 21 the cash program that everything's been hooked up, and now you're actually looking for a tenant or a buyer for this home. Mm-hmm. Mm-hmm. Once everything's hooked up, the cash program actually reimburses you that down payment, that $2,000 to $3,000.
Okay.
So essentially, you're out of pocket $0, just a few $1,000s for a couple weeks, couple months, depending, and then basically you're reimbursed. And then your job is to find a buyer for that home. And of course, the cash program will be the bank financing the tenant that home. So that's how they get their money. Mm-hmm. Once the house is sold, the cash program actually puts a mortgage on it, gives the money to the manufacturer, and you, the operator, gets the lot rent. So everybody wins.
Wow. Okay. So it's beneficial for everybody. Yeah, I see how it kind of fits together. And what was, just for FYI, what was the sales price on that new mobile home?
It's a very good question. And it does fluctuate, and you have to go with your market. So in our market, most homes are around $40,000-$45,000, maximum $50,000. Now, mobile homes can go up to $150,000. You can get really nice ones, but it wouldn't be something that we would put in our parks because that's not our population's needs. Really need affordable housing. So anywhere between 40 to 50,000 would be our range.
Yep, got it. So I kind of want to go back real quick to step one, which is you said that you're buying three community or not three communities, rather three mobile home park or three mobile homes is what I'm trying to say.
Yes,
three used.
Three used, and that was about $10,000, give or take, right? So you buy those. What is your costs, your expenses involved in moving that mobile home onto your property and then getting it hooked up and ready to go for each one, or maybe as a total?
Well, like Janie said, $2,000 to $3,000 per home is average numbers in Michigan, anyways. And so my $10,000, like we bought two recently, all hooked up, everything done, delivered, $25,000. Was two homes. So for $12,500, we had everything up and going.
You go the hauling of the trailer in your price as well. So if you can get that in there, why not? But about $3,000 is a good.
Yeah, because like I'm in Texas, but I know these costs can be pretty significant, right? So you're buying a mobile home for $10,000, but then moving costs could be anywhere from $3,000 to $5,000 or even more. So it's like, you're buying it for $10,000 and it costs you $5,000 to move it. So really it's like $15,000. So it was just something that I had I had a question there. So, okay. So that is awesome. You guys have been able to accomplish, a lot. And I mean, you look very young, by the way, if you mind me asking, what are your ages? Because you guys look very, very young.
Yeah, we're not very old. I'm turning 33 soon.
29.
29 and 33. And so you guys are financially free. You guys have been able to do this in such a short period of time, which is really, really amazing. So I really admire that. So the other thing I wanted to ask you, going back to the very, very beginning, was the mindset. What kind of took you guys, to that next level? What was the mindset that you had to go through? Just kind of talk about that briefly, real quick.
Sure. I mean, if you want to do something different, you have to do something different up here in your mind, of course. And so when we decided that we wanted to do real estate, and that was not something that we basically knew how to do, we definitely understood that to be successful, we needed to change our mindset. So that was a given to us. So we started looking up books and listening to podcasts. The first book that we read was Napoleon Hill's classic 1937, Think and Grow Rich. So that a lot of perspective on the mindset. And then from there, we did a lot of personal growth and professional growth because we come from very modest backgrounds. Now, the mindset is everything. You really need to change your mindset, change your life. And that's a true statement. You can have a lot of dreams, but if you're not willing to change your mindset and go after them, make a plan, and it's just a wish at that point.
Exactly. Yeah, you can have said it better. I mean, you have to have it like up here in your mind, but then you also have to take the action to be able to get to those points. Because one without the other is just a wish, right? So you're exactly right on that. Okay, so good deal. So, guys, it is time for our nuggets of wealth, and these are questions that I ask every guest every week, and these are going to be a little bit generic, but these are specific as well to you specifically. So question number one is, what is a good tool, source, or platform that you use almost daily that can also help others?
All right, I'll take this one. And it might sound silly, maybe not silly, but anyways, I'm the systems guy. I'm the one who likes to know that all the pieces are working and they're well oiled together. And seeing that we have 3 companies, Wemindji Property, which is the real estate acquisitions, mobile home parks and whatnot. Jakey's Real Estate Partners is basically coaching, consulting. We're helping people achieve financial independence. And S.T.R Properties, which is short-term rentals. We haven't even spoken about that at all. But there's so much in each one of those companies that there's so much data, passwords, systems, partners, communications. We need a way to keep everything centralized and organized. Otherwise, you're just lost day to day. You have no idea what's happening. And so Trello.com. It sounds really silly what it is, but it's just a data flow, deal flow, data storing, organizer. It's just columns and cards. Every conversation that's recorded is recorded with notes, key elements, got passwords in there, log boxes, just everything is all in one place, and it's mobile friendly. So we're, sometimes we get stopped and we just need this data, and we don't have our laptop, take out the phone and there it is. So that's definitely something we use all the time. We use it for our assistants. We use it, everyone is using that, and it keeps everything centralized. So this is Trello.com. Is that correct? So it's
Trello.com. Trello.com.
Exactly.
Gotcha.
Exactly.
Okay. Yep. Good deal. Okay. What was the best business advice you ever received?
We were definitely in favor of mentors, other people's mistakes. So learn from other people's mistakes. Find yourself a mentor and follow the process. You don't have to reinvent the wheel. People have done it before you. Yeah. So that's why we got to where we are today. We followed a step-by-step process. We of course built on that, learned in tremendous amounts in the beginning, and built on that. And that's how we were able to get where we are today.
Yeah, you have to have somebody that's been there, done that, right? And everything that you do.
Otherwise, where do you start?
Well, otherwise, where do you start? And not only that, but you think that you may be saving money by not hiring a mentor, but at the end, it could have cost you way more.
Absolutely.
It's just going to cost you way more and not only in financially, but also in time. So I definitely agree. That's something very important for if you have that plan and that wish to grow and to do something big. Okay. Which book are you currently reading, and which has been the most impactful for you?
I'm currently reading Hustle. It's this one here. So
Hustle. Okay. I haven't seen that one before.
Yeah, Neal Patel. I mean, we must read a book every 2 weeks. So we've read quite a few books. So this one is the one that we're currently reading now. I'm starting it today. So I can't really tell you what it's about, but it's entrepreneurship. So always.
Hey, anytime it has something to do with entrepreneurship, it's going to be, most likely it's going to be good. So
there you go.
Hustle by Neal Patel. Okay, great.
And the one that probably influenced me the most, I think the 4-Hour WorkWeek for me was changer. And we've read that one quite recently, and we made a lot of changes in our business, which really freed up a lot of time to do even more than what we do. So definitely that's one of my, one of my favorites.
Yeah. Well, no, I really like the 4-Hour WorkWeek as well, because it seemed like every page we'd read, there'd be just this practical tool that we could implement immediately. And we did implement so many. And even though in his book, he's really referring to like an online sales system that he can automate. And so you'd think real estate, well, it doesn't really fall into that category. Well, maybe not everything, but there is a good chunk. And so we did. As simple as another little tool that we use every day is Boomerang. It's a small Gmail app that it's free at first. And if you use it excessively like we do, it's like $5 a month or a year. And it allows us to organize emails, and so that we never have more than 50 emails in our inbox, and we receive hundreds a day with all of our businesses and everything that happens, and all of a sudden, poof, it becomes extremely manageable for one person like our assistant to handle.
And on the topic of as well, another one that I really like is Sean Anker's Happiness Advantage. That's a mindset-driven book, and really just proves that be happy with what you have when you're in pursuit of what you want. And that's been a life changer for me.
Mm-hmm. That's a very, very good point. And I'm glad that you brought up that book, because, we forget, sometimes we think that, success is a destination, but it's not about that. It's the process and what it is today. And if you think that you're going to be happier, 10 years from now, 5 years from now, whenever you get to a certain point or a certain goal, you think that's going to make you happy, then, you got to have a huge wake up call, because that's not necessarily happiness. Happiness is today, in the moment today, right now. Whatever you can do it right now, it'll just amplify that much more whenever you do have those, those goals, or you have achieved those goals, right? So very, very good point. I'm glad that you brought it up. So, okay. What's the biggest mistake you ever made?
Biggest mistake we ever made was, it's hard, because we're the type of people who every time we see, okay, we did a mistake, we goofed. But then again, we just learned so much from that mistake that it doesn't become a mistake anymore. It's just a learning. So, but in general, if I'm going to give advice, and it's something that we did in the past, but we've learned and we'll never do it again, is just start in a deal undercapitalized. Yeah. So especially when you start going into the larger asset class, undercapitalized just means you don't have enough money, not to buy, because like we've shown, like we bought a mobile home park for $2,000 out of pocket. Like you can buy real estate for almost no money down, or no money down if you're, if you're creative enough, or you're savvy enough, or create a good enough solution for everyone. But does that mean you should buy it necessarily if you don't have any money? No, those are two different questions. Can I buy it and should I buy it are not the same question, because especially these larger assets, when something breaks, when something goes wrong, it's a bigger bill. And if you don't have the money, especially when you hit the commercial, the multifamily space, where a lot of the asset's value is in the income it generates, that income, then suddenly it's not worth as much, and there goes your buffer, and there goes your hair. You don't. It's just have capital reserves when you do major rehab projects, and when you're buying large assets, you want to have a nice big buffer that you can even just look at. Might hurt thinking, okay, that money's not going to work, but believe me, it's worth to look at, to know it's there. And when things go wrong, not if they go wrong, when they go wrong, you'll be ready, and you can just move on by and keep the thing going and ride the wave.
I agree 100%. My first property, I'll say it really quick. My first property was a 32-unit, multifamily property, and that was a property that we acquired it. It was good, but one thing I did not do was I didn't set aside a CapEx budget. Mm-hmm. So because of that, a lot of the repairs, a lot of the maintenance and those kind of things was coming out of the cash flow, and the property was making good cash flow, but it got diminished because of the repairs and all that good stuff, right? So so make sure that you account for that separately. So going back to your point, you can buy something for $2,000 down or whatever. That it can be your all-in costs. Let's say $5,000. But should you and the other thing is, maybe you should bring in somebody else if you don't have all the capital. Mm-hmm. They could bring in, $50,000, $100,000, whatever it's going to take to have that buffer, and kind of piece it together. So it's better for you to give up a little bit of the deal, and be in a better situation versus you trying to, buy the whole deal by yourself and then you're in trouble later on because you 100%. Can't do anything. Yeah. So that's a very, very good point. Yeah. What do you guys see your business or businesses in the next 5 years?
So 3 businesses, 3 main goals for the next 5 years. Let's start with JK's Real Estate Partners. This is we want to coach 10 individuals and hit independence, financial independence for those 10 people. That's JK's Partners. In 5 years, we want 10 people to follow our tracks and become financially independent. For Wemindji Properties, this is where we actually buy real estate. We want to buy we want to acquire 50 unleveraged small multifamily properties. 50 unleveraged in the next 5 years. And for S.T.R Properties, we want to host 500 investors or homeowners. Right, hosting is the term to mean basically manage short-term rental properties. Mm-hmm. So we want to help 500 individuals, whether investors or homeowners, live mortgage-free or rent-free.
Awesome. Yeah. So I want to kind of touch on the unleveraged part, where you said that you want to acquire, I think you said 50 unleveraged properties. Yep. What's the plan there? Because for people listening, it's like, wow, how do you even think about having 50 unleveraged properties? What is your goal there? What is your plan? How do you plan on accomplishing it? If you could kind of summarize it like within 30 seconds or so.
It can't be summarized in 30 seconds because there's so many things happening all at once. But a combination of just creative acquisitions, bringing in partners, like you say, where there's just no mortgage on it. So if a partner comes in, no bank financing, boom, that's one unleveraged. We're obviously generating cash flow and income. We can just buy these outright cash. So that's another way to do it. So just these type of strategies, especially what's really nice with S.T.R Properties, something that happened recently is we offered a hybrid master lease option deal on a motel in Branson. It didn't pan out, but basically the agreement was that we were going to manage their motel for them for the next 6 to 12 months, help them boost up the financials, and then we would go on and acquire the property. So there's a lot of different ways to buy real estate in the pre, the current, and the post phase of what is considered traditional real estate.
But essentially, we're going to keep acquiring real estate with mortgages, and we're trying to mitigate risks as well with unleveraged properties. So our portfolio is quite balanced, and we like it that way.
There you go. A lot of ways to skin the cat for sure.
Absolutely.
Okay. At the end of your lives, how do you guys want to be remembered?
A very good question. Definitely, we want to be remembered as people that have impacted positively the lives of other peoples around us, especially in the realm of real estate. That dreams do come true when you put your mindset and your mind to it and you work hard for what you want. Definitely, we're strong believers in that. Strong believer in women in power, women in entrepreneurship. Don't be afraid to raise up to the challenge and surround yourself with like-minded individuals. I'm a strong believer in that. So I think we want to be remembered for the impact that we have on people's lives. Have something to add? And
for me, I just want to be remembered as the person who made her dreams come true. That's all.
Hey, that's a good way to be remembered for sure. Okay. Where can Commit to Wealth Nation go to contact you guys and find out more about what you guys are doing, and maybe if somebody wants to get a hold of you or get in contact with you?
Awesome. So the easiest way is by email, info@nowfortomorrow.club. That's our email address, and nowfortomorrow.club is the website.
So nowfortomorrow.club. And I did mention briefly our ebook, JK's Roadmap to Your First Million, one property at a time. It's free. It's on the nowfortomorrow.club that you can download it. That's that. And if anybody is interested in the S.T.R process, it's str-properties.com. There's a nice little section in there. It explains what we do, how we do it, and you can just literally put in your address, and we will send out a complimentary market averages report. So we're connected to the back-end office of these short-term rental booking sites like Booking.com, VRBO, Airbnb, and so forth. And so we can pull data from your market with your property address and property description, and we can tell you, hey, if you work with us, this is what you can expect. Numbers. In the next 12 months, your two-bedroom can generate you $20,000. Or whatever it might be. Well, we can spit out the occupancy rate and how much other people with a comparable unit is making in your market right now.
Got it. Okay, well that's great to know. So info at nowfortomorrow.club and strproperties.com. Okay.
STR-properties.
Yeah, str-properties.com. Yeah, sorry about that. Okay, well, Janie and Kyle, it was a pleasure to have you on. I really do appreciate your time. I appreciate the value that you've been able to add. Lots of good advice, from single family to manufactured homes to you name it. You pretty much talked about it here, but I really do appreciate your time. Thank you so much, and I wish you guys continued success for sure.
Thank you so much for having us on your show. We really appreciate you and your audience.
CommitToWealth.com, creating a legacy by committing to real estate wealth.